Good evening, everyone. Time for another silver update. This is the 1 hour chart of silver provided by netdania.com. You can click on the link below. Now, this is the most current downtrend line that we've been watching. I've drawn kind of a support trend line that's been met a number of times, and then we're seeming to fall out of that. So we're coming towards a critical juncture here of whether or not this downtrend line will hold. A break up through it would be short-term bullish. Of course, a rounding off and turn down would be very bearish, because we're accelerating in our down trend lines. So we're waiting for this to resolve. This will probably resolve within the next day or so. We're coming up on the end of the year. I think tomorrow. I know tomorrow is options expiration. I don't know if it is the end of the delivery month. I don't think so for the futures. I think that was earlier. So I don't know how many trading days we have left in the year, but I would guess not many. So probably before the end of the year, this may resolve itself one way or the other. So we're watching that, and of course always trying to look for bargains of physical silver to stack. Now, the main story of the night, I'm going to try to cover just a cursory glance at it because it's such a big story, and I've really just kind of I'm really just kind of touching upon the issue. But I'm going to start off with Ted Butler's latest that he's issued for the public from his newsletter, and he goes into this issue of the SLV Short Position. Now, I don't have time to read the whole thing because there's too many things I need to look at. But the first thing you really want to notice that stands out here is that Ted points out that the short position for SLV increased by more than 2.2 million shares to 25.2 million shares. So there's roughly 25 million short shares of SLV. Now, he goes on to explain the difference in a short position in a commodity futures contract as opposed to the difference in the SLV ETF. The big difference, without going through all this, is that every time you have a buyer of a commodities contract, you also have a seller. So you have one long for every short. It's not the case in these ETFs. So I'm going to read the last two paragraphs here because this kind of sums up Ted's point about this. That an unusual and extreme amount of short selling should appear in the two most important silver trading entities is beyond coincidence. The concentration on the COMEX and the amount of short selling in SLV is stark, verifiable, and visible to all. Both will tell you all you need to know about the unusual behavior of the price of silver when analyzed with a common sense filter. But the greatest lesson of all is what all this shorting should tell you about the future behavior of silver prices. More than anything else, this need by a few commercial crooks to have to resort to excessive and manipulative short selling should tell you about the real condition of the physical silver market. It is because the silver market is so tight and that large quantities of real silver are unavailable that the commercial crooks have to sell short so blatantly. If you can't sell the real thing, you sell the next best substitute. Without the COMEX and SLV short selling, the price of silver would be dramatically higher, since there has never been a legitimate explanation for the concentration on the COMEX or the excessive short selling in SLV. I am convinced both forms of the manipulation and fraud are coming to an end. As the scrutiny increases, you should not let up in complaining about these crooked shorting mechanisms or acquiring the cheap silver they have created. So, and Ted put that out on the 16th. Now, I wanted to dig further into this issue, and I really can't do a full analysis. I'm just going to give you some rabbit trails that you can follow, because there's a lot of rabbit trails. They go really deep and they lead to some very strange places. Now, the first thing we want to keep in mind is this 25 million ounce figure. And if you understand shorting, basically a brief explanation is this. As Jesse Livermore said, he who sells what isn't his'n must buy it back or go to prison. and that's the famous short saying. And Livermore was talking about how when you short a stock, you're borrowing it from the existing owners. So you can't short something. Now, this is going to bring in the issue of naked short selling and the DTCC and failures to deliver. So I'm going to propose here that the situation is probably much worse than Ted thinks it is. So let's keep in mind this 25 million ounces of short SLV shares. Now, the first thing we want to ask is who owns the shares. That's key, because when you go out and short a stock at your brokerage, if you want to short Apple stock, let's say, in a normal market, historically, not the market that we have now with all these failures to deliver, but in a normal historical market as we had in the past, if you went down to your broker, my broker is TD Ameritrade, and you said, hey, I want to short some Apple stock, and they'll be, how much do you want to short? I'd like to short 1,000 shares of Apple. Okay, let's see if we have 1,000 shares of Apple. So they're going to look around the brokerage for all the people who own stock in street name, and if they have someone there who owns that much, then they will loan it to you. That's part of the agreement of holding your shares in street name, and then you'll be able to sell that stock, and then you owe the stock. You collect the money and you owe the stock. So that's the basic principle of shorting. It gets more complex when you're waiting for these shares to be delivered that you shorted. They're allowing you to sell them before you have them, sort of thing, and then you get into failures of delivery, you get into naked shorting and all that stuff, and that's a whole other topic. But let's keep in mind this 25 million ounces, and we want to ask the question, who owns the shares? Now, I did happen to find a link that is on StockZoa, and this is apparently from reported information that comes from the filings. It gives the QSIP number. So this is a list, the latest as far as I know, and very interesting. At the very top of this list, we have Bank of America owning 22 million shares worth nearly $1 billion. So if you're going to borrow these shares to sell them, and I'm going to show you how I don't think that's actually the case, but if you were doing honest shorting and you wanted to borrow these shares to sell them, odds are you'd probably have to borrow some from Bank of America. You can see they own almost more than 10 times, nearly 12 times the amount of the next highest group that owns these shares. So this is the list of the current owners, and of course this is never timely information. It kind of gives you a historical thing. But what really jumps out at you is when you get down to this list of funds who sold out of iShares Silver Trust. Now these are the people apparently that liquidated the shares. I don't know why I just went to some kind of tweet, so we'll refresh here and get that information. But you can see what really jumped out at me when I first saw this list. I saw, oh, well, it looks like this is a quarterly report, because we see all of these people sold out September 30th of 2011. And sure enough, we go back and we look and we see we had this report from June 30th. So it appears to be a quarterly report, and it just tells you who sold out of the iShares. Now, the question I would like to ask is it just people who sold out, or is it people who sold it? In other words, are these potentially naked shorters who are shorting SLV, or are these people who owned it? I don't know the answer to that question. But let me take you to some of the strange stuff that I found here. If you go all the way down to the bottom of this list, you see it actually is historical. It goes quite a way back. You can see that Archon Capital Management sold on March 31st of 2009, and the next report we get is December 31st of 2010. So that's a decent jump there. That's a long time between any reports. Then we get another report there, another one. So we had a number of people sell out on December 31st of 2010, which, by the way, was right at the bottom before you've got JP Morgan Chase here, who's going to come up another time when we look at the SLV. But you see this amount here, a very tiny amount starting out, and then a trickle here. And then we get some people who sold out in March, And then what we find so interesting is we have a large number here that are listed as selling out in June. And that seems pretty big compared to the prior list. But wait until we look at September. September 30th. This is the list of all of those that sold out of the SLV on September 30th. So that's a real startling number. Now, it's even more startling when you bring up the silver chart and you look and go to the daily and see. We've got to take our line off here. If we move in and see, oh, guess what? Right around the end of September, when we have this enormous number of sellers of SLV shares, again, whether they're shorters, I don't know. Whether they're naked, I don't know that information. And corresponding to our other period, which was June 30th, we have right before that this enormous smackdown in May. So just coincidentally, at the exact same time that we have all of these people supposedly bailing out of their shares of the SLV, we get these two enormous smackdowns. Now someone might say, well, yeah, their stops were triggered and they got out. I don't think that's the case. So to give you a little more evidence on that, I want to take you to the Yahoo series of volume figures that I pulled. If you remember, I watched the historical volumes and very closely. Now keep in mind this figure that Ted cited, the 25 million shares short. Okay, so we have, and we want to look at one of the introductory articles here to see the information about the SLV. You can see on this page they give you a rough outline of it. You have shares of 300 million outstanding. That's where we're at today roughly. You've got about $9 billion in value. You got about 300 million shares outstanding, and total ounces is 311. So these are the numbers we're looking at. We're looking at about 300 million, and Ted told us that we had 25 million outstanding short, which is not quite 10% of this float. So that's not that unusual. But what is very unusual is when we get to this number series here. And you can see, if you remember the May Smackdown, the first thing that jumps out at you is we actually had a ramping up before the Smackdown occurred. But then we go and we break through the 100 million share volume, and we get 189, 125, 155, 180 as we're nearing this top. Then we get the massive May Smackdown. We get 106, 184, 217, 184, 294 when we touched down to 33. That was our low. We had nearly 300 million shares trade on that day alone. Now that is the shares outstanding. So what they're telling us is the entire float of the SLV changed hands on one day, May 5th. Now you explain to me how that occurred. So my guess is it's beyond what Ted is saying in registered shares of the 25 million. It's actually much worse than that. My guess is a lot of this volume here is naked shorting, and this adds up to about 2 billion shares of this thing. So that's a real strange one, and it just gets stranger and stranger the further you go in. So I wanted to take you to a filing that is, these are required to be done by the custodian and the sponsor. And we're going to look at that in a second, but back to that information we had here on the iShares. This is actually the iShares site. If you go to the iShares site, you have this periodic SEC reports. So they have to file periodic reports with the SEC. When you go to that, you get these lists of reports. Now, the one that I chose was this most recent 10Q quarterly report. And then we dig into the meat of this 10Q. And there's a lot here. Again, like I said, these are a lot of rabbit trails. You really have to study this stuff closely. But it gives you the outline here. The iShares Silver Trust was organized on April 21st, 2006 as a New York trust. The trustee bank is the Bank of New York Mellon, which is responsible for the day-to-day administration of the trust. The trust sponsor is Blackrock, and the trust is governed by the depository trust agreement executed, etc. And the custodian, that's the three key players we have here. Let's find that here. JP Morgan Chase, London branch. This is the custodian, and they are responsible for the safekeeping of the silver bullion owned by the trust. So you've got Bank of Mellon, you've got Blackrock, and you've got JP Morgan. So you tell me, are those people that you trust? Now, as we begin to dig into this 10Q, there's also some strange things that kind of jump out at you. First of all, you have to look at the language very carefully. The objective of the trust is for the value of its shares to reflect at any given time the price of silver. No, the price of silver owned by the trust at that time. Okay, so they're not telling you that the purpose of this trust is to reflect the price of silver. The purpose of this trust is to reflect the price of silver owned by the trust. And we're going to see when we go down and dig into the details about the cost structure and how they pay for this, which is by selling off the silver. And you can see here there's going to be some things that really jump out at you. Let's get down to the tables here. If we go down to the cost analysis, now here are, this is a real key here. You can see the number of shares redeemed. Up above they gave the number of shares sold to maintain the cost and to pay off the sponsor and the trustee. But you can see an interesting statistic here that we had this period of this quarter, and it reports for the 3 months. You've got July, August, and September, and you can see the average ounces per share. Okay, and do you see how that's declining? You go from 0.9745 to 0.9742 to 0.9736. So the amount of silver that one share of this trust represents is decaying on a continual basis, and that's due to the costs. If we go up and look at that reported, I believe that the quarterly reported number was $15 million. That's the amount of silver that they had to sell to pay for the cost of this trust. So hopefully we can find that figure here. And here's your proceeds from sales of silver to pay expenses. These are in millions, or in thousands. So you've got 14 million, roughly 15 million for the quarter. This is for 3 and 9 month periods. So this tells me they're charging $15 million a quarter. This is all based on percentages and things like that. So basically, they took $60 million worth of silver and they dumped it on the market to pay for their expenses. So this is a built-in system where the key players, which would be BlackRock and JP Morgan, are slowly siphoning off the value of this silver. The amount of silver is decaying on a regular basis, and it is on its way to zero for the value of the shares, and it's going to not represent anything but the value of the silver held in the trust, which is being continually sold off. So you can see it's apparently a really big racket. So that's the iShares Silver Trust, the SLV. That is a deep hole, and there are so many things you can follow, so many rabbit trails to follow. I've done some research here on Blackrock, and when you go in and look at Blackrock, they ended up acquiring Barclays, who was the original creator of that trust. And then you get to look into the history of Lawrence Fink and his creation and spinoff from Blackstone, and how they managed that. Now they've managed to take over Barclays, so they actually, BlackRock is now in control of the iShares SLV trust. This Lawrence Fink happened to be at First Boston. He was one of the first people who came up. Fink was instrumental in the creation and development of the mortgage-backed security market in the United States. And BlackRock, who was just a very small player, actually ended up getting tapped by the government to help them manage this financial crisis. The U.S. government contracted with BlackRock to help them clean up after the financial meltdown in 2008. Although BlackRock is widely believed to have the best choice for the cleanup job, Fink's long-standing relationships with senior government officials have led to questions about potential conflict of interest regarding government contracts awarded without competitive bidding. In December 2009, BlackRock purchased Barclays Global Investors, at which point the company that Fink co-founded 22 years before became the largest money management firm on the planet. So, from its birth to 22 years later, it is now the largest money management firm on the planet, and it controls billions and possibly even trillions of dollars. And you can see they're all in bed with the government. They're all in bed with the banks. So it's a big rabbit trail. It goes a long way, and the players are probably the most shady characters that you can imagine. So I definitely think that Ted Butler is onto something, but I think that the problem is probably much, much worse. It goes much, much farther than even Ted thinks it goes, and you just have to go through all these reports to try to figure out the rabbit trails and where they go. So that's the top story, SLV Shenanigans, and with the volume we saw on those days where it traded hundreds and hundreds of millions of shares, it can't just be those 25 million shares short. It's got to either be naked shorting, massive churning, or some type of shenanigans to report those types of volumes. And we're not even looking at the arbitrage question and how the shares are cross-referenced with the futures contracts on the COMEX, and how naked shorting or massive selling in the SLV is arbitraged over to the COMEX and what impact that has. That's a story I'll have to do in the future. I want to take you over to the Blogroll really quick, and the first story is going to be Jim Willie. That's the latest. Jim Willie is always excellent. I actually didn't have time to complete the article, so I'm going to have to do that tonight. But he calls it COMEX, the March to Irrelevance, and I think we've pretty much documented with the SLV, these are all going to be irrelevant fairly soon. It seems to be snowballing now. The next is Bob Chapman, a very good read. I suggest you read it all the way through because he really goes into detail about his views about what's going on. This article is an article that actually came from the Liberal blog, and it's the crooksandliars.com. It's generally doing mostly liberal stories, but if you want to see an expose on a quote-unquote conservative, so this is an expose on Mitt Romney, and it's trying to document his connection to the Stanford financial group. I don't know if you remember, but right after Bernie Madoff went bust, this Stanford guy went bust. Bernie Madoff went bust for about $50 billion Ponzi scheme. This Stanford guy was running about a $9 billion Ponzi scheme, and he kind of doesn't really get that much news headlines because he wasn't as big as Madoff. But apparently, according to this person, Caroli, who's a blogger, documented the connections between Mitt Romney and this Ponzi scheme that blew up. And there's the Ted Butler article that we just covered. And we've got an interview with Ann Barnhart where she is calling for a complete financial strike. She's liquidated everything that she has. She was in the cattle futures trade, and she was a introducing broker, and she's advised all her clients she's getting out and returned all their money. So that's the Blogroll. Oh, and the last one, of course, is the armed Chinese troops in Texas. No, there aren't armed Chinese troops in Texas, but this gentleman gives you an idea of what we would think if there were, and comparing it to some of the things we've done overseas. It's excellent. I highly suggest you watch that. So I want to mention that you can see my updates appear on my blog. Because of the processing times that I'm having to deal with, you will see my updates appear on the blog sometimes before. If you want to know the exact time, you can go to Twitter and you can follow me on Twitter. You can also follow me on Facebook, and when something posts to my blog, it will be tweeted, so you will know. But as far as the YouTube subscriptions, it will be roughly an hour or 2 hours. So if you want to catch something really early, you can catch it on my blog. Ultimately, when the processing is finished, it's going to appear on YouTube. So that's the chart we're looking at for silver. We're still waiting for this latest situation to either turn down or break through the descending trend line to give us some type of trend direction. And we'll talk to you next time.